What's up, millennials? In exchange for your time and hopefully you like as well, today we're going to take a look at the fair valuation of the Lion Electric, which is a company that's going to be acquired by the Northern Genesis Acquisition Corp, which so far is trading under the ticker symbol NGA. Now, I've already done multiple videos about valuations for popular SPACs like ChargePoint, Romeo, and Luminar, and the Lion Electric was actually one of the most popular ones for this one. Today I'm actually going to try to go a little bit quicker through the calculations, so let me know in the comments if it's actually too quick or not. Okay, the first step that we're going to take is to calculate the pro forma market cap and the enterprise value. And for that we're going to take some of the variables from the investor presentation of Lion Electric and of NGA. We're going to use a base share price of $10, which is quite normal for SPACs. So it's $10, which is the price that I put in here in my Excel spreadsheet. Then we need the amount of shares that are going to be outstanding after the merger has been completed, which can be found over here, which is going to be 194.9 million shares, which I put over here in my Excel sheet. And then we can already calculate the market cap, the pro forma market cap, based on the share price of $10, which is simply by taking the amount of shares times the price per share, right? So we have 194.9 million shares, and we multiply that by the share price of $10, and that gives us a market cap of a little bit more than $1.9 billion. So the next thing we do is to calculate the enterprise value. How do we do that? Well, we simply take the equity value, the market cap in this case, of 1.9 billion, and we take out, or we subtract, the amount of net cash. And as we can see in the investor presentation, they're going to have $494 million in net cash, but they also have $51 million in debt. So I'm just going to go ahead with a net amount of cash of $444 million. And some might probably say, well, this is a difference of $443 billion, or million dollars rather. That's correct. But there are probably some rounding things or some rounding issues, because the difference between this number, the equity value, and the enterprise value over here is $444 million. Okay, so we take the market cap of 1.9 billion, we subtract the amount of net cash, and that gives us an enterprise value of $1.5 billion, which is exactly the same number as we can see over here in the investor presentation, right? But the thing is, right now, if you go to TradingView, we can see that NGA, and right now it's actually diving a little bit in the last couple of minutes, it seems. But right now it's trading at a price of $16.44, right? So that's higher than the $10, and we are going to take this number. So we've got $16.44. Let's go back to the investor presentation. So we can see that now, because of this increase in price, the market cap has also increased, right? It went from, let's go back here a little bit, $1.9 billion, and now is at $3.2 billion. And that means that also the enterprise value has increased from $1.5 billion all the way up to 2.7 or almost $2.8 billion. So that means that investors right now say, okay, based on the current price of $16.44, Lion Electric is worth about $2.8 billion. The next step is going to be to calculate the future enterprise value. And we're going to do that based on taking the future revenue, or the EBITDA numbers, and multiply them by a certain number, a certain multiple. We do have the future revenue and EBITDA numbers for 2024 for the Lion Electric. We can see that if we look at the total amount of revenue, they expect to have a revenue of $3.6 billion, and they expect to have an EBITDA of $707 million. The only thing is that this investor presentation doesn't give us a revenue or EBITDA multiple. So what I'm going to do is I'm going to compare these numbers with a similar company, Hyliion, because in their presentation, if we go back to this one, or if we actually go to the investor presentation of Hyliion, we can see a few things. We can see that they used an EBITDA multiple of 7 to 9x, and they also based it on their 2024 EBITDA numbers. So we're going to take that exact same EBITDA multiple of 7 to 9x, and we're going to apply that to the 2024 EBITDA, which is right over here, $707 million, right? So 707 million times 7, that gives us a low enterprise value of about 4.9 billion, which is the number that I've already put in my Excel sheet over here. So that was the low valuation. And if we go to the high valuation, we take the same EBITDA, 707 million, and now we multiply it by the revenue, or sorry, by the EBITDA multiple of 9, which is now going to be $6.3 billion more or less, which is the number that I've put over here. And then if we add another valuation, which I'm going to call the midpoint valuation, which is basically the average of the low and the high valuation, then we're going to arrive, according to my Excel sheet, at an enterprise value of $5.6 billion. So low valuation in 2024, 4.9, high valuation 6.3, midpoint valuation 5.6. Next up is going to be to discount the enterprise value back to today. So we have already got the enterprise value of 2024, but now we want to know the enterprise value of the current moment in time, right? And we're going to use a discounted cash flow method for that. We need two things for this: a discount rate and the amount of periods to discount, right? For the discount rate, we're going to look at the investor presentation of Hyliion again. So in this investor presentation, we can see that they used a discount rate of 20% and they discounted it back 3 years because, yeah, they were looking at the 2024 EBITDA. 3 years back is 2021, and which is almost the year that we are living in, right? So we are going to use those same numbers. We're going to use a 20% discount rate, and we're going to also take the 2024 EBITDA numbers and discount this back 3 years, 3 time periods, right? So what do we need to do? Well, we take the low valuation of the Lion Electric, first of all, of 2024. So that's 4.949. And we now divide that by 1.2. The 2 here stands for the 20% discount rate. And we do that to the power of 3 because we need to discount it back 3 years in time, 3 time periods. And that gives us a low current fair enterprise value of about $2.9 billion, right? Which is a low valuation. That is the number that I've put over here, so $2.864 billion. And we're going to do exactly the same with the high valuation. Let's go to the high valuation, which was, let's see, 6.363. We're going to do exactly the same formula, so divided by 1.2 to the power of 3, and that gives us a high valuation of $3.682 more or less billion, which is the value that I've put over here in my Excel spreadsheet. And if we now take the average of the low valuation and the high valuation, we're going to arrive at an enterprise value post-merger of about $3.3 billion. And now the last step is going to be to calculate the fair market cap and the fair price per share. Because right now what we have done so far is to calculate the fair enterprise value after the merger, right? Now we just need to add the net amount of cash to arrive at a fair market cap after the merger. So for the low valuation, we had calculated an enterprise value of 2.8 billion plus the amount of net cash gives you a market cap of about $3.3 billion. And for the high valuation, it was about 3.7 billion enterprise value plus the amount of cash gives you a market cap of 4.1 billion. And then you arrive at a midpoint valuation of $3.3 billion in enterprise value plus the amount of cash gives you a market cap of $3.7 billion. Now, to arrive at a fair price per share, the only thing that we need to do now is to take these market caps and divide these by the total amount of shares outstanding after the merger, which is going to be 194.9 million shares, as we've said in the beginning of this video. So we take these market caps, we divide that by the amount of shares, and then we're going to arrive at a low price per share of $16.97, a high price per share of $21.17, and a midpoint fair price per share of $19.07. All right, so there you go. A fair price per share after the merger would be $19.07. Now, a few notes before you leave. First of all, never trust me, always verify me, right? I could be completely wrong. I am just a random guy on the internet. I'm not a financial advisor. Always do your own due diligence, your own calculations to verify what I'm saying. Secondly, we're talking about assumptions, right? We have been taking a look at EBITDA numbers from 2024. So these are projected EBITDA numbers and projected revenue numbers. We've taken a certain EBITDA multiple based on the investor presentation of Hyliion, which are also assumptions. And always take into account that we're talking about investor presentations here, which are usually made attractive to investors to make the investment seem attractive as well. And the last thing is share dilution. Always take into account that the company might issue additional shares, more outstanding shares, which would lead to share dilution, meaning that the fair market cap usually stays the same, but the amount of shares increases, which means that the fair price per share is going to decrease. All right, with that being said, thank you very much for watching this video, and I hope to see you in the next one. Stay safe. Bye-bye.